Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And today, the guys and I are going to talk about two really big topics in mortgage land these days. The first is some prediction that mortgage rates aren't expected to fall below 6 for the next 2.5 years. I don't know. I disagree with that because, well, I'll get to that in a second. And then we need to talk about credit. So an article ran this week off Investopedia talking about you have to have stellar credit in order to get into the housing market. However, our firsthand experience is different than that. So you don't just have to have an 800. So let's unpack that. We're going to start with the rates thing first. So the New York Post ran this article with a graph. So the graph is showing that mortgage rates are hovering in the low 6s, but the MBA chief economist presented a prediction that mortgage rates are going to stay between 6 and 6.5% through 2028. Do you agree off the bat? Do you agree or disagree with that?
I disagree.
Okay, disagree. Why?
I mean, based on everything we've been seeing, noticing, the way that, the reports have been coming out, I would like to know off of what basis they're saying that this is going to happen when we see the 10-year pushing down below the 4%, and that's a huge indicator of saying, hey, rates are coming down. So it's like, I understand what they're saying. People lie, numbers don't. So I'm seeing, the facts and the numbers don't align with what people are saying through their mouths.
Okay, hold on. So what is the advantage of him saying that, though? What you're saying, people lie, fact don't. Okay, yes, I agree with the 10-year yield thing. They're citing things like budget deficit and inflation expectations is the reason why rates are going to be high. But I'm with you on the 10-year yield thing. 10-year yield is breaking below 4 and staying below 4. And it's like, if it breaks that support and continues downward, that's going to drag rates with it. So I'm with you, but why would he lie? What's the idea behind that?
I mean, that's what I would like to know as well. I mean,
but you said it. I'm asking you, why are you saying he would lie about it?
Yeah. I mean, I guess for lack of a better term, I don't know if the information he's saying is very accurate. And that's why I'm like saying, well, what is he basing it off? I'm basing it off seeing the 10-year come down. So I'm saying, hey, that's what I'm looking at. I don't know why he would lie about it, but I think that, whenever people, speak on the market and they say something, it could influence certain decisions in the marketplace, but it doesn't necessarily mean that it's going to happen exactly like that. So it might be some sort of manipulation or some smart tactics.
Well, or you know what? He's just getting his information elsewhere. Who knows? He's probably just taking a wild guess. And the thing is, he's probably going in that route because of what happened last year. Last year, same thing, right? Jerome Powell spoke. We had a good August, September month. And then as soon as he spoke, what happened to interest rates? Everything just went up, just similar to what happened this time. The only difference, the last time in October, we already seen the interest rates in the high 6s, low 7s. Right now, we're seeing the low 6s to mid 6s on conventional financing, which is a really good indicator that I feel confident this is incorrect because of the way we're going, especially when we consider that October 29th, when the Fed meets once again, 97% chance that we're going to get another Fed funds rate reduced by 0.25%.
Yeah.
And so the stats are very high. We need our economy to start getting better. Our housing economy we're in crisis right now, and that's a fact. Affordability is at its worst. And really, where do we generate most of our income from? It's real estate. So I disagree with this 100%. And why is he saying this? I don't know where he's getting his data from.
Same.
So everybody looks at it different. I follow Barry Habib.
Yeah, exactly. So I'm just kind of like, bruh, what are you saying here?
Well, and maybe there is something else that he's looking at that we're not looking at. They're not sharing here. That's always a possibility. That's a possibility with everything. But I'm generally with you guys as well. Like if the 10-year yield is dragging below 4% on a daily basis now on the trade, then I think that mortgage rates have softening ahead. Yeah. If the Fed's going to cut the rate in the end of October by 0.25%, then that's going to signal rate cuts ahead, right? On the mortgage side of things, it's an indicator. Now, I understand that when typically they've said that before, rates go right up, but the week or two leading up to that, rates ease, which is happening right now. So the week prior to the Fed meeting, what are rates doing this week? They've been easy on Monday. They're easy on Tuesday. Maybe they'll be easy the rest of the week. The other thing I'm going to say here too is that if you were going to have mortgage rates go higher, that would put price pressure on homes and they'd have to come lower because of the affordability you're talking about. But if we've already seen that home prices have like flattened or stayed because we're not seeing rampant price reductions. We're seeing price reductions within the same range as we normally do on any other year, which means that The only way for it to get better financially for people is for rates to go lower. And that's also an incentive for the bank to keep volume coming in the front door. So I am definitely seeing this very one-sided. It was very confusing for me to see that prediction, because also, in my nerd head, I'm looking at the dot plot chart. Remember that from a couple weeks ago? The blue chart with the Fed's prediction of where rates are going to go? Well, in 26 and 27 and 28, they were also predicting that rate would be lowered in the future as well. So there's no reason, from what I'm seeing, to jump on board with this opinion.
Yeah, no, absolutely. I mean, the whole thing. So for the audience that haven't listened to us in the past, the 10-year Treasury is really how mortgage interest rates are reflected on us. So right now we broke that, that bottom line, that 4%, which is great. That's a good indicator that we could start seeing some easing in the market when it comes to interest rates. But if you're waiting to see interest rates in the low fives, you may be still waiting a while to get into that home.
Yeah, I think one of the things we could see right now, if rates don't go much lower, I mean, we've had, I think the same rate for like the last couple of years, we've played within the 7 to 6 range. So you have an idea of what prices are looking at. And if things hold out a little bit longer, at least you know what you can expect.
Yeah, absolutely.
Yeah. So I know that was kind of like a quick hit today, guys, but I'm looking at a couple of things. Yes, it's great to have forecasting. I think it actually is a great indication of where they're positioning themselves, and where the MBA is saying, hey, we're going to kind of be like right here. They, again, just like us too, when in the future, you can look back in the rearview mirror and go, oh, yeah, they were right or wrong. You can say that about everything we've ever predicted on this show, just as much as we're critical of them saying these things in advance too. Same thing with the Fed. If they cut in October, they make another cut at the end of this year. Maybe they only make one cut in 2026. Maybe because other financial factors and economic stuff are looking at, maybe they don't have to cut again. But I am definitely more of a fan that we're going to see 6 or below. I think predictively that we're going to see 5.5 to 6, not 6 to 6.5. I honestly, long range thing, I think that's where we're going to be.
I mean, yesterday I just qualified a nurse, and his husband, who is a diesel engineer, they're living out of Santa Ana, and we qualified him at $860,000 purchase price with 5% down, conventional financing with the whole mortgage insurance, etc. The payment came in roughly around 63 and change. I did qualify him at a 6.375, charging him no points, nothing like that, which is not bad. Because that, if we would have backtracked 6 months ago, it would have been more like a 6.875, So we've seen about a 0.5% drop on this. And
that's a big amount. That's pretty amount. Substantial.
Yeah, no, absolutely. And, so one of the things that I did right here, although rates are around the 6%, isn't bad considering the historic the averages. But given that the home prices today that are much higher, it just creates where you can't afford that. Yeah. Affordability is not there. It makes it difficult. And so in this case with this young couple, obviously they want to stay within a mortgage of $5,000. If we really look at that, and that's $860 and your payment is 63, let's just round out to 64. That's quite a bit. Coming from renting to just owning, that's a big difference in payment. When you're like, wait a minute, my payment's like $3,000. I have to pretty much go double and some.
Yeah, that's a lot.
It's a lot.
Yeah, and again, if you're qualifying for that and you're saying, hey, this is what it takes to get into the neighborhood I'm looking at, or the specific zip code or wherever it is, that kind of, I hate to say it this way, and I'm way too casual. It's like, it is what it is, right? Yeah. I hate to say that, but it's also true. At the same time, this is the driving factor for why median monthly payments are higher now than they were 2 years ago, and they were 5 years ago, because everything's just much more expensive than 2020, and I don't think we're going back to that. So, predictively, as many people as we can continue getting into the market now with some skin in the game, and they can afford it, and their job is secure, I think that's setting the course for what we're looking at down the road. Well,
even this year, in comparison to the other years, in October, this feels much better. You kind of feel like there's a little bit of light at the end of the tunnel, right? We're hearing the right things. We're seeing the right things, at least in our industry, we're starting to see a little more, things are not as crickets as it was the past 2 years.
Yeah. And I'm going to add on to that thing. Last year, when the Fed cut rates in September 16th, I believe that's when the whole downfall started. And after that, we saw the rates were good for like June, August, and then bam, things dropped. Even them saying that they were going to cut the rates, we saw that negative effect. And I don't think we saw it that big this year because it's been very flat from.
We were in the sevens.
Yeah,
going into the new year, we were already in the sevens.
And even going, yeah, exactly. So it's like now, I mean, completely different, 1% difference, and you see the difference in transactions of people that are getting into their houses, or refinancing for that matter.
Just from an anecdotal perspective, as a business, we haven't had this many units and this much total loan volume in October since 2022.
Yeah.
24 wasn't like this. 23 wasn't like this. 22 is kind of the tail end of the 21 peak and 2020 where there's a lot of just throughout the year that was happening. But we haven't had this much volume since 2022 in October.
Yeah, exactly.
So this is a good sign.
This is a good sign. Things are still happening, which is a really good thing. A good indicator that we're going in the right direction for sure.
Now, here's the irony. Switching gears, but still kind of talking about the same components and variables here, is this wild article from Investopedia talking about you need stellar credit to buy a house in this housing market. And this just seems like it's one slice of the pie for a certain type of buyer that excludes FHA, excludes USDA, excludes VA. Yeah. And it's just like, no, you have to have the most crispy, clean, squeaky clean credit ever. Otherwise, you can't get in the market. It's like, no. Hold on. Hit the brakes. Yeah. Let's hit the brakes on this one because the data doesn't tell the whole story.
Absolutely. I mean, in this market, credit is not just the number. That is the gatekeeper. That's really what's going to help us catapult to make sure that we're getting that best interest rate. Going back to the conversation that I had earlier of the new couple, when your credit scores are above a 760, everything goes in tiers, and that's what the regular consumer doesn't understand. You start off, and I'm just going to go here in tiers of 19, right? But in this case, we went from 680, and then your next tier is 719, and then 720, 739, 740, and on. So anything above a 740 for me is like consider excellent credit. Some say 780 and above, but we're going on these tiers. They're so important, Andy, because what happens is the mortgage insurance premium shifts. It becomes lesser and lesser. And what people don't understand, in this case, yes, I was able to go FHA with this consumer. Okay. But what happens is, remember, FHA has that 1.75% upfront mortgage insurance premium that gets tacked onto your loan. And then additionally to that, you have the monthly mortgage insurance premium was 0.75%. So because their credit score was above a 760, my mortgage insurance, along with conventional, does not have the upfront, which is great. Nothing gets financed on top of that, which is great, And then the monthly was only 0.19%. That's a huge difference. Yeah. So even though my rate was a 6.375 versus the 5.75, my payment was still lesser by $200 and change a month.
Yeah, easily.
I take that approach better. Why do I want to add on, at 860, 1.75, I want to say it was around 14,000 and change. Why do I want to add that to my payment? And then my payment's going to also be higher? Like, that's just, I'm not taking that route.
Yeah.
And the reason I wanted to have this conversation today is because there's more that meets the eye. The number is the number, but the number is a reflection of a lot of other things. It could be the length of history that your credit lines have been open. It could be your current balance compared to your total limit. It could be the mix of credit you have. It can be late payments if you have late payments. And the just the like surface level argument of, well, if you have bad credit, you can't buy a house. That's not the case, because there's a lot of ways to fix your credit and work on your credit. A lot of times, how many times do we look at someone's credit and they don't even know something's on there that's hindering them, and you go, oh, we got to do a rapid rescore, or write a letter, call the bureaus and get it fixed because it's bad data. It's a common name and someone else has their name and it's on their report, or they pay off an account and it wasn't closed. I mean, there's all sorts of things that drag credit down, but to just say that the number is a reflection of how hard or easy it's going to be doesn't tell the whole story. Exactly.
I do like the article. One, it helps clients to understand, the consumer understand where they need to go. Well, a lot of times what people don't understand is if interest rates drop and your credit's still in the low 600s, you'll never see the benefit.
Yeah.
It's hard to see the benefit. So you really have to be strategic what you're doing and plan ahead. Revolving credit has the best, indicator. If it's all about credit utilization based on your revolving credit. So if you're at 30% or less, that's ideal. That's where you want to be. That's where you're going to see your credit scores just go up and increase and just put you in a way better position. And so that's what people have to focus. If you have student loans and sometimes they have like, well, I only owe $1,000, let me pay that off. It's an installment, and so a lot of times paying that off actually hinders your credit. Paying a vehicle off is also considered an installment loan. That hinders your credit, because what happens and what people don't understand is once you pay that debt off, there's no more history to rate you.
Right.
Good job. 2 thumbs up. You paid your credit card. That's great. I got nothing else to rate you in the following month.
Yeah. Yeah.
And so there he goes.
So if you're in a position where you're like, oh, hey, I don't have a 740 or I don't have a 720 or a 700, like there's a roadmap to get yourself there. And it might take some time and it might take some money. You're going to have to pay down some of your balances to that 30% mark utilization of total available credit limit. And also address the things that are incorrect in your credit report. Now, the byproduct of that is what the argument of the article is making, which is, oh, then your score is going to be high and you'll also have a 750 or whatever. So again, it might just take a couple of steps and then you'll end up being there too. But if you're trying to buy a house or you're trying to refinance, these are the things you're going to have to be aware of. I just don't want to subscribe to it just patently being, oh, well, you got to have amazing credit in order to do this. No, you can clean up your credit in order to do this, and you can still get a loan at 680 or 660. It's just not going to be as favorable. It's going to be a lot harder, maybe, because they're going to scrutinize the mix of the things in your credit report that have generated a 680 or 660.
Absolutely.
But that doesn't mean it's a no.
We've done as low as 560.
On
credit
VA?
scores. Oh yeah, in VA. Yeah. It happens. You just have to have compensating factors. And if AUS doesn't accept it, which is DU, an automated underwriter approval, doesn't take it, you do a manual, you stay within a certain oh my God. Debt to income ratios,
the residual,
and the residuals there, you're fine.
Yeah.
But again, the interest rate's not more as favorable as it is, and there's a lot of times where we get the client in there, considering that we already have a plan ahead and how we're going to work up to get their credit increase, so that after they make their 6 payments, and they pass the 210-day mark, we're in a position to help them and refinance into a VA IRRRL, which is an interest rate reduction refinance loan. And that's a lot of times. It's like, don't keep yourself out of the game. If you're already pretty close to getting in there, also don't discourage yourself. There is plans that we can put in effect, or talk to your lender. You can put plans in effect to just help you get there.
Yeah. And I think that's why it's important to just sit down with somebody right now. If you're unsure of your credit or you don't understand what you're able to do, like that's the first step, just reading your credit, seeing what can be fixed, seeing if anything needs to get fixed. Because a lot of time I feel people will say, I have too much debt. But in reality, we go based off the minimum payments that get reported in your credit report. So although maybe you're paying hundreds of dollars, when you get approved, they're going to look at it a little bit different, but you won't know all those insights or all those options you have unless you sit down with someone that could actually help you understand it.
No, absolutely. Absolutely. One thing I like about this article is we see the average credit being hit 736 mid.
Yeah.
That's pretty incredible. I mean, I don't think I've ever seen that since I've been in this industry, So that's just telling us people are becoming wiser and they're understanding the importance of credit, and that's a good thing. Actually, it gets me like, all right, good job. I applaud you guys for doing that. Credit is a lot. Credit's everything. Not just when you're purchasing a home, when you're getting a credit card, when you're purchasing a vehicle. These things will come into play and will save you thousands of dollars, because you're making that sacrifice of paying everything on time, keeping your credit utilization be low 30. And if you can't do that, 40. If you can't do that, under 50, just don't go over that. And you'll be A-okay. You know what I mean? So I like that this comes with this information, 736. I like it.
Yeah. And I think also that's also a pure reflection of just who's in the game. Like who is buying houses right now and who already has a house that's refinancing. It is people that, for the most part, because of their income, they don't have to rely as heavily on credit. Now, before you jump on me in the comments, you're like, but remember when you said that show, people were doing debt refinances and taking equity lines of credit? Yeah, I remember that show. I remember all those shows. Yeah, people who did get themselves in a pinch financially would look to the home to refinance, pay off debt, things like that. But then after those things are paid off, what happens to the score? It comes right back up again. Yeah. So even if you had come to us and you have a 680 or a 700 and you're using a HELOC or a cash out refinance to pay off your car, student loan, debt card, credit cards, well, okay, after that's all paid off and those lines of credit re-reporting to the bureaus, you're going to shoot up past 700, 720, 740 right away. Yeah. So it's partly a reflection just of who's in the game, but I don't want that to discourage people who might be sitting here going, I only have a 660. Okay, why? Why do you have a 660? What does it take to get 680 or 700? Let's have the conversation and figure it out. quick side note, if you missed the show with Sarah Khashrabadi from a couple weeks ago on Friends of Mortgage Heroes, she's a consumer protection attorney. She was talking about how after COVID, everyone can check their credit on a weekly basis now, not just monthly or every 6 months. So you can actually get your credit checked once a week and monitor more closely with frequency the things that are changing your credit as your credit agencies are reporting to the bureaus.
Oh no, I'm part of Experience. So when my credit is dropping, it tells me, it sends me an email, your credit's dropping because your credit utilization. Then I'm like, Tanya, what did you buy now?
What did you? Yeah.
What did you buy for me?
Just like I was buying your cologne. I was buying your cologne.
Tickets for the vacation.
No, I was buying your hair gel.
But I tell you, these things are so important because it's like, you have all these tools. And again, we always have resources. And what helps us become that much more successful is when we understand how to use them. And that's the key part of things is learn to use our resources. Success is right underneath our noses, but if we're not paying attention, it's not going to happen.
Do we need to end on that? We need to end on that, Brian. Yeah. No, mic drop, pen close, end of show. Yeah, no, you're right.
Next week.
You're right.
Facts.
I mean, look, when Sam came here on the show, like last year, he was talking about, hey, success leaves clues. Like, so is your credit. And there's a roadmap to get yourself to where you want to be when it comes to being financially fit, having a mortgage that serves you, and you having a house and a home that you love and enjoy every single day.
Absolutely. One of the things I do want to share with our audience and people that watch this is, when your kids turn 15, you could add them to your credit card as a joint account user. I did that for all my 5 boys, and so I knew that there's going to be a point in time, especially when they turn 21, when they no longer want that car that you bought them, right? They don't want the little Kia. They want to go now, hey, I like BMW, whatever, right? And so here they go. They come knocking at your door and say, hey, Dad, Mom, can you co-sign for me? I don't believe in that. I take care of my credit. Like, I do not let anybody borrow my credit. I'm just not going to do it. I don't care. It's my kids. I trust them. Like, no, thank you. I don't know what challenges they may have in life that could ruin my credit because I'm on there, And so sure enough, it comes. They're like 22. Dad, can you help me with the cosign? I go, whoa, what's needed? And they're like, well, I'm going to go buy a car and I don't think I have credit. And I'm going to have you ran it? No, go run it. Go run it. And then go apply. And sure enough, Dad, I have excellent credit. Yeah. Yes, because I added you to 3 of my credit cards that I had over 3 years that I've been having them open, and my credit utilization is under 30%. So you pick and choose your battles in what you're going to put your children in. Do that, and I'm telling you, you're going to love the outcome.
That's awesome.
Hey, Brian.
They inherit that credit history, essentially.
Did you picture the same thing I did? Like, Ashton comes in the room, dark, smoke-filled room. There's one light over the desk. There's like a cigar. He doesn't even smoke cigars. He's like, Dad, I don't want to buy a car.
Oh, yeah, son?
Go check your credit.
Go check your credit.
You ran it? No.
I love it.
Yeah.
That's an awesome idea.
I mean, you guys saw Ashton at 20 when he bought his car. He went and leased it. We lease all our cars. He went in there and he leased it on his own. There was no pay stubs required. Nothing. Just his credit was good enough. They're like, here you go, take the bill. It's under his name. I no longer have that obligation there.
Yeah.
It's just phenomenal.
And that's awesome for sharing, honestly, because a lot of people might not know that, and that could just help make a huge difference in 10 years, save them so much money, but at the same time, just set them up for success.
Absolutely. Yeah. Any clients that ask, hey, I'm going to add don't do it. Don't do it. I'm so again. Listen, just have them wait 3 months, add them there, 3 months, have them run their credit. That information should already be on their credit. They inherit that information.
Yeah. Nice.
Thank you, Susan Orman.
Susie Orman. Okay. All right. I think that's our first Susie Orman shout out on the show ever. Well, thank you guys for a great show this week, and thank you all for watching. Remember to like the channel, subscribe, and turn on notifications so you catch every episode we release. And also remember to check out our other playlist called Friends of Mortgage Heroes, where Will, Brian, and myself interview our friends in and around real estate to do a variety of things that are unique and different that really help you win in mortgage and real estate. So you guys, thank you for a great show this week.
Thank you guys.
We appreciate y'all watching, and we'll see you again with another great show next week. Later.
See ya.
So if you enjoyed this video and got value from it, subscribe right here. And if you want to watch another video, click right here.